Welcome to Everything Financial Radio. I'm Dennis Tubbergen, and you're listening to the Legacy Radio Network. Glad you're with me today. Boy, a lot to talk about here as 2012 gets going. On today's show, we're going to talk about, or I should say, ask the question, is this the last dance for Greece? We're going to talk about the Federal Reserve back in 2006 and how they just completely missed the housing collapse. Transcripts from the meetings of the Federal Reserve for 2006 released this week. A couple articles I'll share with you. Going to talk about the 2012 forecast. In fact, if you'd like to get a complimentary copy of our 2012 Market and Economic Outlook, it was just released last week. You can go to investingapproach.com. That is investingapproach.com. Give us your name and address. Let us know where to send that report, and we'll be glad to send it out to you. Also on this week's show, I'm from the government, and I'm here to help you. We're going to talk about what's going on in Buffalo, New York, and how the politicians and policymakers in New York are trying to do in Buffalo what the politicians and policymakers have tried to do in Michigan and Detroit for many, many years, and following a parallel path there. And also, we're going to talk about Europe's bad day. Last week, Europe had a really bad day. Standard & Poor's, the rating agency, stripped France and Austria of their AAA credit ratings. And get this, if you are the Greek government and you go to the bond market now and say, I'd like you, Mr. Investor, to loan the Greek government money for 1 year, yields on 1 year Greek debt are now over 400%. That means when the Greek government goes to investors and says, loan me some money, this is what they hear. Also on today's show, we'll be talking about economic cycles. You know, there's a lot of folks out there that would say that history does repeat itself. And way back in 1925, a Russian economist by the name of Nikolai Kondratiev published a book titled The Major Economic Cycles. And he stated his view in the book that capitalist economies move in boom and bust cycles. And some modern-day economists and commentators, Mr. Ian Gordon, who's been on the Everything Financial Radio Show for one, have taken these cycles and divided them down into seasons, the spring cycle, the summer cycle, the autumn cycle, and the winter cycle. We're going to talk about on today's show what cycle we're in and what it might mean for your money. Also, momentarily, we're going to go to the phones and have a conversation with Mr. Mish Shedlock. He's been on the Everything Financial Radio Show in the past. Mike is a very, very prolific economic commentator, always has a very interesting point of view. We're going to talk to him about what's going on in Europe and also talk to him about something we don't hear too much about here, and that is the elections that are taking place in Europe and what that might mean not only for the European economy, but the American economy and you and your money as well. So a lot to talk about today. Also, a quick reminder, if you would like to attend one of our discovery groups, you can go to personallegacyseminars.com. That is personallegacyseminars.com, and see where we will be in the West Michigan area. Just click on the location and date, and there will be more information that's available there. If you'd like to register for a discovery group, just click on the link, and information will be there to tell you how you can register. I have on the phone with me Mr. Mish Shedlock. Those of you that have listened to Everything Financial Radio for any period of time know that we've had Mish on the show several times and always appreciate his insights. Mish is a prolific economic commentator, speaker, and also an investment advisor. So, Mish, very glad to have you on the show today. Give us your take on what's going on in Europe. I noticed that Greek one-year bonds are now over 400%, which is essentially investors laughing at the Greeks, saying there's no way you're going to repay us. How long can this propping up the European economy continue?
It's pretty amazing here. The IMF today was proposing another $1 trillion lending expansion program, and they're going after China, they're going after India. Interestingly, they're not going after the United States. It would never pass U.S. Congress, by the way, right now to give any more money to the IMF. But what people don't realize is that China's reserves are already spoken for. They're already invested in U.S. Treasuries. You know, what does Europe want them to do? Sell them in U.S. Treasuries and buy Portuguese bonds? And why would they want to do that? Everyone can look and see what's happening here with Greece. Actually, the interest rate hit 1-year interest rate hit 420% today. So right then and there, that's the bond market didn't seem to think that this talk of this PSI, where this new debt deal is going to pass. Now, perhaps it does, and perhaps it doesn't. But as far as I'm concerned, it's all irrelevant. Greece is going to default later on this year anyway. The latest proposal is a 68% haircut. And some people are saying, that haircut is so big, maybe I'll just take my chances and see what happens later. Actually, I think it would be 100% loss. But the real sticking point here is that there are some group of investors, mainly hedge funds, that have credit default swaps written that will make them whole in the case of Greece defaults in a credit event. So they're actually rooting for a credit event. So today the latest word is that no, in spite of what the Financial Times said earlier today, in spite of what Greece says, in spite of what the IMF says, these bondholders here are saying, you know what, no deal. We won't take this big haircut. We won't accept this haircut. And we would just as soon see Greece default, and they will collect out on their CDS, which is an insurance bet that essentially says they're betting that Greece is going to fail. So there's a lot of vested interest out there that wants Greece to fail. Actually, I think it's in Greece's best interest to fail. There's no way they can pay this stuff back. I don't think it's in any bank's best interest to keep throwing money at Greece. 2 years ago, there was about $50 billion in Greek bonds out there to deal with. Had Greece defaulted at the time, maybe the write-offs would have been 25, 35 billion maybe, because some of those were owned by Greece, not by France and Germany. Instead, they've poured almost 200 billion more trying to stop a $35 billion default.
Sounds like a decision that might have been made by politicians.
$35 billion default.
Yeah, it sounds like a decision that was probably made by politicians, and they seem to they have the same line of thinking, many of them, no matter where you are in the world. Mitch, one thing that comes to mind, when Greece defaults, and I agree with you, I think it's a matter of just months. In fact, I've said that I think the euro fails in its current form by the end of 2012. We'll see if that happens or not. What does that do to banks? How many banks are we going to see around the world become insolvent due to the fact that Greece actually defaults and they've got to write these bonds off?
Well, banks are insolvent whether Greece defaults or not. Not a lot of people realize that, but if you just look at how leveraged these banks are, in the United States they're claiming 20 to 1. It's probably higher than that, but in Europe it's more like 100 to 1, some of them. What happened is, well, they did all load up on all of this sovereign debt, but not just Greece, but of Spain, of Italy. The ECB, Jean-Claude Trichet, the outgoing, the former president of the ECB, Jean-Claude Trichet, just had this policy, insisted there will not be any haircuts on bonds. We say no to default, blah, blah, blah. Banks went out there and, oh my God, I can get 12% on a Portuguese bond. Why do I want to get 2% on a German bond if there's going to be no defaults and we're going to be made whole on everything? So it all started with a phony premise that such and such a thing would not happen. So all these banks levered up, not just in Greek bonds, but Spanish bonds, Portuguese bonds. Portugal is going to implode next. I think we're going to see, talk of a Portuguese default. Actually, it's starting already, places like my blog, but I think we're going to see more serious talk of that on the mainstream mainframe probably within a couple of weeks here. They've already been downgraded by all three rating agencies to junk bonds. So we now have Greek bonds and Portuguese bonds at junk levels. I don't think Spain can hold out. The economic problems in Spain are enormous. The unemployment rate is something like 23% right now, 23.8% maybe. And it's going to get worse. They're imposing more austerity measures and raising taxes, smack in the middle of a recession. Europe is going to have one heck of a recession, and there's no way there's not going to be spillover into the United States.
Mish, we've got just about a minute left, and we'll certainly pick up the conversation on the other side of the break. But quickly, we'll start talking about this. What's your take on how the euro looks a year from now?
How the Eurozone, I think we're going to see I think Greece is going to be out of it. I think Portugal probably be on the way out of it. I think the ECB is going to try and put a fence around the rest of it, but I don't think Spain can stay in it. So I'm not sure Italy has the willpower to stay in it. But rather than looking for one event where everyone just leaves, there's also a possibility that Germany just gets fed up with this whole thing and leaves it and says, okay, Eurozone, you can have it, and in which case Austria and the Netherlands and a couple of the northern economies would probably leave with Germany. So depending on how this goes about and who's left in the euro depends on where the euro goes. Certainly if Greece leaves the euro, Portugal leaves the euro, Spain leaves the euro, and it's just France, Germany, and Italy that's left. Well, maybe the euro rises in value after we take into consideration this initial defaults and all of that stuff that happens. Otherwise, if it's Germany that leaves the euro, then the Deutschmark strengthens and the euro collapses. So it's the manner in which some of these things happen, and we don't know that. There's a lot of elections coming up in Europe. Maybe we can talk about those elections when we come back. But there's a lot of elections coming up in Germany and France, actually even in Greece, that are going to determine which one of these outcomes we're going to see.
Great. We will talk more with Mr. Mish Shedlock after these words. Stay with us. Welcome back to Everything Financial Radio. This is the Legacy Radio Network. This is Dennis Tubbergen. I'm talking with Mr. Mish Shedlock. And, Mish, we were talking prior to the break about Europe, the future of the euro and the Eurozone. You had mentioned that there are a number of elections coming up in Europe, and certainly social unrest we've seen here in the United States. Also, Europe is no stranger to social unrest. How are some of these elections going to play out in your view?
Actually, this is a very critical year for elections, even in the United States. But let's talk about Europe first. The French President Nicolas Sarkozy is on his way out. And the interesting thing about that is he might be defeated in the first round of elections. And by that I mean, for those who aren't familiar with how French elections go, all the political candidates enter a preliminary election in April, and then the top two finishers, the top two parties, whichever ones they are, square off in May. And right now, Sarkozy is in second place, but it's a very tentative second place in polls for the first round. There's a candidate, Marine Le Pen. It's a woman, actually, but she is running on a platform that says France is going to leave the euro. And I don't think she can win, but she can certainly bump off Nicolas Sarkozy in the first round. So, but the second stage polls suggest that a guy by the name of Hollande, who is the top vote getter in the first round, would also beat either Le Pen or Sarkozy. So either way, Nicolas Sarkozy's out. And Hollande has come out and said he wants to rework the treaty that was worked out between France and Germany, between Sarkozy and Chancellor Merkel of Germany. So either way, there's going to be a disruption. There will certainly be a major, major disruption if Marine Le Pen won. I don't think she will. But I think Nicolas Sarkozy is gone, and he had a lot of credibility among the European leaders. This new guy that comes in is a socialist. He lacks the credibility of Sarkozy, and he wants to undo some of the things that Sarkozy did. So essentially, we're going to take this treaty that Germany and France worked out, and it's going to have to be reworked once again. Meanwhile, in Germany, Chancellor Merkel is losing a lot of her leadership and sponsorship. Her election is not till 2013, but she's only running. She's in a coalition government right now, a minority government. She needs a coalition partner to get her above the 50% rating that she's at. And there are threats from her coalition that they're just going to back out. That would force a vote of confidence and perhaps her to step down before this. Either way, I don't think Merkel survives in 2013. So the big two key architects, Germany and France, the politicians of those countries that forged this alliance, this agreement that's being worked out now, they're both going to be gone. So I think we're going to see some major changes there. Meanwhile, they're working out this agreement in Greece that we talked about. Greek elections are coming up in April, and once again, whatever agreements worked out right now is likely to be redone in April. Meanwhile, let's look at the United States elections. We have a candidate that's in the lead, Mitt Romney here for the Republicans. He's running on a platform that says if he's elected, he's going to declare China a currency manipulator. With that's going to come increased tariffs. I think, we're going to have a global trade war if Mitt Romney's elected. I think that's probably a 50-50 shot right now that he is elected, and if he is, we can expect trade wars. So the whole global macroeconomic picture looks absolutely horrendous now, no matter where you look. We have the Chinese economy slowing down. That's going to affect Australia. Europe is headed into a massive recession for all of these austerity reasons and all of these things that we're talking about here, sovereign debt defaults and raising of taxes. And the leading candidate here in the United States is threatening a trade war with China. That is the global macroeconomic picture right now. And it's, quite frankly, it's horrendous.
And Mish, it's always fascinating to talk to you, and we're out of time. I sure appreciate the time. And when you look at what's going on in Europe, just in the minute or so we have left, and look at what we're talking about as far as trade protectionism. It's not unlike what happened really in the 30s with the Smoot-Hawley Act, when everybody kind of pulls back and trade declines, and it really exacerbates a recession. And in the 30s, it exacerbated a recession into a depression. Hey, Mish, if somebody wanted to learn more about your work or read your commentary, can you give them your web address as to where they can read your blog?
I'll give you the web address and an easier way to find me. My web address is globaleconomicanalysis.blogspot.com. That's a mouthful. So the easy way to find me is just do a Google search for Mish, M-I-S-H. It's the first two characters of my first and last name, Mike Shedlock. Do a search for Mish. It'll take you straight to my blog. I talk about global economics, global politics, interest rates, gold, oil, the stock market, emerging markets, every day of the week, usually 4 times a day.
Yeah, he's a busy guy, and thanks for joining us today, Mish. We'll have you on again soon. This is the Legacy Radio Network. You're listening to Everything Financial Radio. Stay with us. Everything Financial Radio will return after these words.